You own life insurance, but I guarantee you don't know the most powerful secret about how it actually works. They've sold you a policy, but they never explain the 3-step mechanical cheat code that turns your tiny monthly payment into a tax-free 7-figure safety net. If you understand this system, the black box of risk pooling and underwriting, you can get 50% more coverage for the same price. Stop guessing and start knowing. In this video, we're cracking the code on your policy's single most valuable feature. From the moment you apply to the moment a claim is paid, what's really happening behind the scenes? It all starts with the fundamental principle that all insurance is built upon: risk pooling. Imagine 1,000 homeowners in a village all agreeing to put one coin into a community pot each month. One day, a fire destroys one family's home. That single family could never afford to rebuild on their own, but because everyone contributed, the entire pot is given to that family to help them recover. The risk of a catastrophic loss was shared by the community, preventing individual ruin. Modern life insurance works on the exact same principle, just on a massive, formal scale. A large group of people, the policyholders, all pay premiums into a giant pool managed by the insurance company. The core bet, based on sophisticated mortality tables and actuarial science, is that only a small percentage of the people in that pool will pass away in any given year. When that tragic event happens for one member, the entire pool, the death benefit, is paid out to their family. Your relatively small, regular premium is what guarantees that massive lump sum payout for someone else's family, and theirs for yours. It's a system of shared responsibility. Now, let's meet the key characters in the story. Every life insurance policy has 4 essential roles. First, the policyholder. This is you. You own the policy, you apply for it, and you're responsible for paying the premiums. Second, the insured. This is the person whose life is being insured. In the vast majority of cases, the policyholder and the insured are the same person. You are taking out a policy on your own life. Third, the insurer. This is the insurance company. They are the entity administering the pool, assessing risk, and, most importantly, making the multi-million-dollar promise to pay. And fourth, and most importantly, the beneficiary. This is the person, people, or entity you name to receive the death benefit. This is who you are protecting: your spouse, your children, a trust. They are the entire reason the policy exists. So the chain is simple. The policyholder pays the insurer to insure the life of the insured. If the insured passes away while the policy is active, the insurer pays the death benefit to the beneficiary. But how does the insurance company decide if they'll insure you and at what price? This brings us to the most crucial part of the process: the application and underwriting. This is where the promise is quantified. When you apply for a policy, you're essentially asking the company to take on a massive financial risk on your behalf. They need to assess that risk accurately. This due diligence process is called underwriting. You'll fill out a detailed application with questions about your age, gender, health history, family medical history, lifestyle habits like smoking and drinking, your occupation, and even your hobbies, like if you're a private pilot or a rock climber. For most larger policies, the next step is a medical exam, often conducted by a paramedic at your home. They will check your height, weight, blood pressure, and draw blood and urine to test for nicotine, cholesterol, and other health indicators. They might also pull your medical records with your permission. The underwriter at the insurance company then takes all this data and uses it to classify your risk. Are you a preferred plus risk, young, healthy, with no family history of early heart disease? Or are you a standard or table risk due to a health condition like high blood pressure or diabetes? This risk classification directly determines your premium. A 30-year-old in perfect health will pay a much lower premium for the same death benefit than a 50-year-old with high cholesterol. You are not paying for the likelihood that you will die. You are paying for the financial risk the company is assuming by insuring you today. The younger and healthier you are, the less risk you pose, and the cheaper your coverage. Once you're approved and you accept the policy, you begin paying premiums. It's critical to understand that every policy has a contestability period, typically the first 2 years. During this time, if you pass away, the insurance company has the right to thoroughly investigate the information on your application. If they find you lied about a significant health condition, for instance, you failed to disclose a heart condition, they could deny the claim or reduce the benefit. After this 2-year period, the policy becomes much more secure, and the company typically must pay the claim regardless of new findings about your initial health, except in cases of outright fraud. This is why brutal honesty on your application is non-negotiable. Now, let's fast forward to the moment the policy is needed, the claims process. When the insured person passes away, the beneficiary contacts the insurance company to file a claim. They fill out a form and provide a copy of the death certificate. The company then verifies that the policy was active and that the premiums were paid. Assuming everything is in order, they issue the death benefit, the entire lump sum amount, directly to the beneficiary. This process usually takes 30 to 60 days. And here's the powerful feature. This death benefit is almost always income tax-free. The government does not tax this money when it's paid to your beneficiaries. They receive every single dollar to use as they see fit, to pay off the mortgage, cover living expenses, fund college educations, or invest for the future. So to bring it all together, life insurance works by pooling the risk of many people to protect any single family from financial catastrophe. You, the policyholder, pay a premium based on your specific risk level to an insurer. In return, they make an ironclad promise to pay a tax-free sum of money to your chosen beneficiaries, ensuring that your financial presence remains even when your physical presence is gone. It's not a complex lottery or a luxury for the wealthy. It is a sophisticated, elegant, and profoundly humane system designed for one purpose: to turn the terrifying question of "what would they do without me?" into the peaceful, concrete answer of "they will be okay."